Hello everyone, this is Matthew Fraley, founder of BreakpointTrades.com, founded it 22 years ago, way back in 2003, to provide advanced technical analysis, market commentary, trade ideas, and of course, mechanical trading systems. Anyway, wasn't planning to do a video today, but given the market bloodbath that we had, figure I might as well. Plus, I will be doing a weekend video as well. Anyway, again, this is the technical analysis review of the markets. It is currently Thursday, April 3rd. Tomorrow, of course, is the fourth Friday. We have the jobs report. Anyway, this theme I made pretty telling for the market. Wall Street bloodbath basically looks like the Walking Dead on Wall Street. By the way, I made that with AI in case you were wondering, but very appropriate. With the Dow losing 650 points today, S&P 275 points. These are just crazy moves. Again, I'm not going to go in. We all know the general reasons why with the market jitteriness, uncertainty, tariffs, whatever. But anyway, if any of you recognize this image here, Samuel L. Jackson said it best from that first Jurassic Park movie, hold on to your butts. And boy, has that been the theme lately. Anyway, this is our backend recorder for our website subscription service, which I'm going to go ahead and get started right now. Hello everyone, this is Matthew Fraley with BreakpointTrades.com. This is the Thursday, April 3rd newsletter. Tonight's newsletter, as you can see, divided into 8 major sections. By the way, I'm not going to add any trade ideas. Not in this environment, guys. That said, a couple of the ideas I've had out. SBS is along, actually gapped up today. It was a really good trade. And AutoZone. Remember, AutoZone tends to do well, especially in recessionary environments. But boy, oh boy, is it a bit of bloodbath. Trump came out yesterday after the market and, pretty much did what he said. I was surprised the market rallied so much that day and popped initially, and boy, did it ever reverse. So today, not surprisingly, absolute bloodbath, which is what my little slide shows here below. As Samuel Jackson said, hold on to your butts. That's from that first Jurassic Park movie, if you don't remember that. Anyway, the Dow Jones lost 1,680 points today. That's 4%. The S&P 500 lost 275 points. Wow. 4.8%. The Nasdaq lost 5.4%. Massive, massive gains. Okay. It's funny, guys. Again, obviously, the Trumps, the tariffs, and the uncertainty are wreaking havoc. But, even before all this, before Trump was even in office in January, our weekly charts, if you've been following us, we were suggesting a strong correction sometime in the first quarter this year. We were talking about this way back in December and January and early February. We were talking about the S&P pulling back maybe to that lower 5,000 range based on the weekly charts. And it's funny how that's happening now. And it's also, whenever you follow technical analysis long enough, it's interesting because you see the setups in the chart way before the news. Then you get the news later that justifies the charts. It's almost like the charts predict it. But anyway, so that's all playing out. Again, honestly, at this stage, myself, and I'm sure most of you guys included as well, I would rather now just see a final wash and rinse out here. The VIX is now starting to move up. It closed up above its upper Bollinger Bands today, I think around 30. But honestly, let's just get this puppy done, wash it out, get that VIX spike. Then maybe we'll get some sort of trade low, at least for a while. Otherwise, remember, we have the jobs report on Friday, and also Fed Chair Powell speaks tomorrow. So we'll see how the markets react to that. Fridays are never good for bottoms, weekend uncertainty, stuff like that. But honestly, we're close enough to a washout. Maybe we get something like that early next week. Next. First image below, item number 2. Here's the unemployment rate. Remember, we have the jobs report tomorrow on Friday at 8:30 a.m. Eastern Standard Time. So we'll see what this does. Again, this is my unemployment rate chart using the 5 and 9 EMA crossovers on a monthly chart. The unemployment rate tends to move like a barge. Once it turns direction, it goes that way for years at a time. So the fact that those moving averages crossed up, last year, to me, this is just going up in the long term. And now we're seeing justifications why this will be going up. I think we had something like over 200,000 layoffs in the government sector and other things. It's hard to find a job now, so we'll see if this starts ticking up tomorrow, but over long term, I expect it to tick up. Next, image number 3. Here's the yield curve, the 2-year divided by the 10-year. This was inverted, as you know, the longest in history. And this has always been the best guide predictor, let's say the best predictor for recessions. Every time this yield curve has been inverted, you get recessions in the future. That's why last year I was always, it confused me when all the pundits on TV talked about the soft landing, the soft landing. I was steadfast. It says, nope, this thing has always worked. Why would it be different this time? It's never different, really, in my experience. Well, now you see, now their pundits are changing their minds. Well, so ultimately, this yield curve predicting a recession is end up going to play out. Next, image number 4. So here's a weekly chart of the S&P 500. Now this still shows the ultimate bullish count where we have this major wave 4 correction. Again, there's all these alternatives in place, such as a major bull market high, stuff like that. But either way, in my opening comments, I said, look, we were looking for a strong correction in early 2025, sometime in the first quarter, down to the lower 5,000 range. That's where a wave 4 would typically take you. I said between 500 to 900 points. Go back and listen to my newsletters in December, in January, in February. Again, I'm not trying to toot my horn here, guys, but we were calling for this. The charts are calling for it. And it's funny how then you get all this, the news here that justifies it and causes it to play out. But it was here before all this tariff stuff and uncertainty and Doge and everything else. So anyway, this is playing out. So we're down in this range. Again, certainly we can go lower, obviously. But just funny how this was well in place before any of this stuff. Next. Image number 5. Here's the KISS. The KISS daily systems, of course, have done their job. Here's the triple Q's KISS system. This exited way back in actually February, just off those highs. So this, as I state here, exited like a boss. It really did. So exited way back here, well over a month ago. If you just followed the daily, you'd have stayed out of most of this correction. It is still flat, of course. That's what the KISS systems were designed to do. Give you this, like insurance for your 401k, something like that. It gives you, gives you that stop protection. Okay, so this did a fantastic job. Image number 6. So here's the S&P 500 KISS system. This also exited. Now it didn't exit quite as well as the Qs because it went back long, not at the best spot there, but it did get out and it's avoided a lot of this. Actually, that's an old image. Apologize, it didn't get updated. So here's the actual updated version with today's big dump. But again, it exited like a boss. Now, certainly, some of the high performance systems have been in and out, but that's what they're designed to do. They're designed to be more aggressive, etc. But pretty much everything's out, guys. And image number 7, here's the VIX, Volatility Index. Closed at 30 today, finally. Nice big move, closing above the upper Bollinger Bands. Now, that could be short-term overbought every time you get above the upper Bollinger Bands. But honestly, guys, at this point, given what the market's done, you think the VIX would be a lot higher. So fear is starting to come in, but it's not crazy like it was in the past. Honestly, and I think a lot of traders would rather have this happen, would rather just see this VIX fear spike. Let this puppy just go up, get up here, wash out, allow price to wash out here on the S&P, and then we get some sort of trade bottom for a while. And chart number 8, here's the 60-minute view of the VIX. Essentially, you had a bull flag that had set up as of yesterday, and then boom, gap up today, running. That said, we are getting a bit oversold here in the short term. Here is the S&P 500 with a couple indicators. Here's the NYHL indicator with the Bollinger Bands, and the VIX, of course, at the bottom with the Bollinger Bands, which is outside its upper bands. But Take a look at the NYHL indicator. It's a breadth indicator, and you can see it's well below the Bollinger Bands. And again, generally when this spikes below the Bollinger Bands, you get some sort of trade low, or at least close to it. You could see examples in the past. Now, the one back here in early March, yeah, I mean, it was still in the middle of the downtrend, but you did get a bounce the next day, one day bounce. But again, the point is we are getting quite stretched here, so just be aware of that. All right, could be getting close to some sort of trade low. Again, could be just a couple days away. Likely at this point next week, just since Friday is Monday. I mean, tomorrow is Friday. Fridays generally are a good bottom and weekend uncertainty. But again, we'll also see how the market reacts to the jobs report, and of course, the what Fed Chair Powell states. He might say something to spike the market a bit. Next, image number 11. Here's the index sector table, what transpired today and this week. Again, guys, look at these losses here. Russell down 6.4%, Nasdaq 5.4%, Nasdaq, well, down 6%, S&P down 4.84%, 275 points, Dow down 4%, 1,650 points. Crazy numbers. And as far as the 21 market sectors, obviously bloody red. Only thing up today, consumer staples. Remember, that tends to be a defensive sector. Currencies, US dollar, absolutely pummeled. Look at that, guys. 1.75%. That's one of the largest down days I've ever seen. Down 2% for the week. So these protectionary moves, not good for the dollar. Cryptocurrencies, Bitcoin down, but not that bad, quite honestly. Just down a little bit. Commodities got pummeled, largely due to that big drop in crude oil, which is down over 7% on worldwide recessionary fears, which would cause less consumption of crude. But big losses here across the board for the commodities. Only thing up was natural gas, up 2.5%. Precious metals got hit. Remember, I said they were getting very extended, so they are starting to pull back. Gold still up a little bit for the week. GDX, the miners. Now, it did recover well off the lows, so pretty impressive. But look at silver, down 6%. Silver tends to be an industrial metal. Remember, it is a precious metal, but it has far more industrial use than gold. It's the best electrical conductor. It's used in so many things. So on a worldwide recession, silver would take a hit much more than gold. And as far as the bond market, well, good drop in the 10-year, 30-year treasury yields. Next, image number 12. Here's the economic news calendar. Like I said, tomorrow we have the non-farm job payroll report, and Powell speaks tomorrow as well. All right, jump into some other charts. Here's the AAI bull bear. Showed this before, but just showing you that this is really firmly in bear market territory. You can see not seen since the 2022 bear market. Usually in bull markets, you get the spikes down, but not into this area. So it just shows you the change of pace. Next, chart 14. Don't often show the Dow. It's 30 stocks, but down 1,680 points today, which is one massive move. Moving on to the S&P 500 chart 15. Here's the S&P daily. Again, you could have that wedge back there in February, which played out. Waterfall sell-off. We had a bounce roughly to the 38% fib retracement. You formed a tight doji over a week ago, which set up an evening star potential. You could have triggered short off that. And boy, look at this move. Look how far we closed below the lower Bollinger Bands. We still have this MACD divergence here, but remember, tomorrow's Friday. Next, chart 16, here's the other daily view of the S&P. There was a demand zone back here extending to September, and for a while today, we bounced off of that in the morning initially, but alas, as margin calls hit, and then Friday's approaching, sold off into the close, closing slightly below that area. So the August lows are just a stone throw away now. Next, chart 17, here's a zoomed out view of the daily S&P. So this was that 5-wave wedge pattern we were talking about back in January, February, which has played out. I'm showing this because, here I have the fibs from that low, and you can see we're closing in on the 38% fib retracement from the 2023 October lows. The 50% fib comes in around the low 5100s. Next, chart number 18, here's a weekly view, just showing the smash down. And here, I added the fibs back to the 2022 bear market lows. And you can see 38% fib comes in right around there as well, 31 or 51.32. So you get a big confluence of fibs right around that low 5100. Could be a magnet over time. Next, chart number 19, here's that 2-hour half-day chart I was showing in the last video. There's a couple options here. One option which I was sort of favoring was this move up in green, but to a lower high and then a big smash down. Well, but we also talked about the bearish option here where we would just sell off right away. Well, clearly the bear case is playing out now. Okay. So that last rally, which was a simple ABC lower high wave 8, well, we're just declining now. Next, chart number 20, here's the 60-minute chart, just showing you this. You know, no MACD divergence here, even on this time frame. Next, let's move and let's discuss the bigger picture charts, guys, since I'm not going to go over a bunch of trade ideas. So a lot of these charts are really screaming at least mean reversion on these bigger picture time frames. So here's the quarterly chart of the S&P 500. So back in February, we had that extended doji candlestick, and just look at the slope the market has had. I mean, talking about blow off move. Look how far it was just above the 9-quarter EMA. Remember, each candle is 1 quarter, 3 months. So now we're correcting mean reversion. And look, we're not even back to the 9 EMA. The 9 EMA on the quarterly charts, 52.17. So that would be a simple mean reversion. Chart number 22, here's another weekly chart. Remember, a while back, Steve and I were talking about how we needed to see a mean reversion here too. This weekly chart has the 89-week moving average here. Price only gets so far away above it before you get a mean reversion. Back here it was 23% above. Here it was around 22%. Well, now we're reverting to the mean. We're almost back to it. Notice how this comes in around the 5200 range. Next, chart number 23, here's a monthly view of the S&P. Now this is a logarithmic chart, but notice we're testing this uptrend line all the way back to the 2020 lows. Here's some of the monthly charts, chart number 24, monthly view. Nice correction here. One thing to pay attention over time is this 14 stochastics. Remember, below 50% is bear market territory. We're still not there, but we're working our way down, obviously. Chart number 25, here's another monthly chart of the S&P with these two moving averages that work very well, the 8 and 13 EMAs for crossovers for bull and bear markets. One thing I was talking about was how these two moving averages were flattened out a month ago, 2 months ago. Then you can see it's playing out now. And finally, chart number 26, here's our S&P 500 401k paint dry system, like watching paint dry. It tends to stay in bull markets for years at a time, but keeps you out of those big bear markets, okay? But you can see here, again, it's still not officially out, but you can see here on the indicator, BPTMA Deluxe 401k, it is now red. Now this is a monthly chart, so it doesn't make its decision until the close of the monthly bar. But at the moment, it's given a sell signal. So if this is still red, come the end of the month, it's going to exit. Okay, so be warned. Next, moving on to the Nasdaq, chart number 27, Nasdaq weekly view down 3.9%. You can see this fifth wave uptrend channel, which we've broken, back tested, moving lower. Still could be a ways to go. Chart number 28, here's the daily chart of the Qs, this wedge pattern, which, boom, is playing out. We're now nearing the September lows. We still have a MACD divergence on the daily, just like on the S&P, but not looking too pretty. Chart number 29, here's a 60-minute view. Again, just like there's a little MACD divergence here, but no bottoming look for me. You can see the last lower high rally stalled right at that supply zone, just shy of the 38% fib retracement off the highs. And chart number 30, here's a 30-minute view. You can see how that last rally stalled perfectly at the 61.8 fib and then boom, smashed down. Finally, here's the Russell. Absolutely smashed, down 6.4%. That's got to be the biggest sell-off one day I've ever seen. So Russell is getting absolutely taken in the woodshed, especially from the November highs. And chart number 32, here's the 2-hour view. Again, you can see the last rally stalled at that supply zone, and it just continues to melt down here. No MACD divergence here at all either. And here's AutoZone. You can see AutoZone had a big rally going today before pulling back, but look how strong this has been. Never even sold off in March. It's been rallying. This tends to do well in recessionary environments, as more people fix their cars on their own. So anyway, guys, ugly. Let's move on. Chart number 34, here's the 10-year Treasury yield. We had this bear wedge pattern, which broke to the downside. So rates are coming down. Now we'll see what Fed Chair Powell says. Chart number 35, TLT 20-year bonds. They move opposite rates, so they're moving higher as you'd expect. And chart number 36, here's high yield corporate. So high yield corporate is leaking oil. Not surprising. It's going to be interesting to see where corporate earnings come in with all this stuff going on, but this is now selling off. 200-day moving average is below. Looking at just a few sectors, guys. I'm not going to look at much here. Here's XLP. That's that defensive sector. Again, it's off the highs today, but you can see it's been rallying. Again, this tends to be a defensive sector. Chart number 38, here's XLK Technology, just getting absolutely smashed, as you'd expect. Same for semiconductors, SOX, down 10% essentially. That's 10% in one day, folks. Chart number 40, here's financials. They're still holding up fairly well, but, coming near the 200-day moving average. Almost has a kind of a head and shoulder look here, too. And one sector that was holding up extremely well was energy. Okay, look at energy down 7.85% today. Wow, look at this. Again, crude oil got smashed. And again, there's fears of world recession, and which would cause less energy usage. So that's why this area is getting pummeled. That said, some of these areas, guys, I've been saying we're going to, emerging markets, world markets, I think are going to outperform the S&P 500. They're going to start doing so. So here's the EEM, that's emerging markets to SPY ratio. You can see how this has been working higher nicely. You can see my comments here way back in January 1st. Emerging markets have underperformed relative to SPY since 2011, watching for this to eventually change. And you can see it's trying to here. You can see this is close to crossing up for a confirmation. Chart number 43, here's the EFA. Same deal. It's been underperforming really since 2008. But trends change, and it looks like this is wanting to change. So, by the way, these are in the high-performance KISS system, so these could be areas to now look at. Moving on to commodities, they got smashed largely due to crude oil, which is one of the larger components, energy names, so down 2%. This is the weekly view. Still in this bigger range, though. Chart number 45, here's the daily chart. Again, it was fairly strong yesterday, and then boom, down 4% today. Chart number 46, crude oil. This is the daily chart, down 6.6% today. So absolutely smashed. It basically stalled right below its 200-day moving average there. Chart number 47, here's the weekly chart, of course. Still stuck in this pattern here, which has been for the last year and a half. Kind of a wedge-like pattern. Chart number 48, UNG natural gas, the lone commodity that was up today. Remember, it had recently found support at its 50-day moving average, bounced off of that. Chart number 49, copper, absolutely smashed, down 4.2%. Chart number 50, DBA, agriculture, honestly holding in here very well. Pulled back off the 50-day, but only down 0.75% today, which is a win. Chart number 51, Bitcoin, actually held up quite well today. It's actually up here a little bit after hours. Now, the last rally, after breaking that bear flag, stalled right at the downtrend line here. All right. Now, Ethereum here is absolutely pummeled. So, came back, retested the lows here. We do have a divergence here, but, no real big reversals yet. Chart 53, HUT, one of the miners. It's still hanging in this pattern that I showed the other day. Hasn't broken down, hasn't broken up. Now, US dollar. Look at this puppy. Chart number 54. Pummeled today. Look at this sell-off. Bear flag there, sell-off, and boy, oh boy. I worry about the dollar, dominance coming into an end and stuff like that. And some of the protectionist stuff we're doing, could be speeding that up. Now, we do have a little MACD divergence here. I don't have it marked, but you do have it there pretty strongly. So take note of that, of course. Next, chart number 55, gold. Started up today before pulling back. Remember, it hit a high of around 3,200 the other day, but still hanging in here. But when the market finally does put in some sort of trade low, maybe we'll see some money rotate out of here. Chart number 56, here's the weekly chart, working on this wave 5 at this point. Chart number 57, here's the monthly view. So again, to me, we're in this wave 5 of 3. So it's not the end of the bull market. We're in a 5 of 3. Once this completes, looking for a deeper fourth wave pullback, and then new all-time highs again. Again, you can see how stretched the moving average ribbon is now. There's some RSI divergence, but still hanging in here, but be cautious at this point. Chart number 58, silver. Silver was the loss for words. Anyway, it was taken to the woodshed today, down over 6%. That is a hell of a sell-off. Again, recessionary fears. Silver is not just a precious metal, but it's an industrial metal. So got absolutely smashed. Chart number 59, GDX. Pulled back pretty strongly, but bounced off that 20-day moving average. Now we'll see. I'm still a little cautious on it here, even though it recovered. Chart number 60, here's dust. That's the inverse ETF. Remember I showed the other day as a really nice falling wedge. It was up nicely today before pulling back. That said, guys, it may simply just be back testing this wedge and it may start to go again. That's why I wouldn't give up on this trade yet. And finally, chart number 61, SBS. This was one of my long picks early in the week and last week. And you can see if you bought it, it was actually up today, 4.3%. Now you need to be in it before today. Buy it, inside the pattern before it broke out. But an example of one of the few long picks here we had that actually went up on a crazy day like today. All right, guys, we'll see what happens tomorrow. Futures are down about 10 points tonight on ES. Again, jobs report tomorrow, Powell, etc. Friday, you name it. Anyway, guys, take care. Thanks for all the support, and we'll see what happens tomorrow.